Kapish Jain, CFO of IIFL, joined just now. Let's connect with him to understand how things are going forward. Kapish, AUM growth is about 30%, Q1 29, Q2 32, which means you're going above your guidance. So on the full year, are you likely to beat your guidance quite comfortably?
Sorry, yeah, we should be able to meet our guidance. As the trend suggests, we should be able to meet our guidance comfortably. Yes. There's a good trajectory, and there's a festive season which is coming up, so that should also help in gaining the momentum as well. And in most cases, you'll realize that second half is always better than the first half. But we already got the momentum, so we should be able to meet our guidance fairly comfortably.
Look at companies like Bajaj Finance, they've reported an uptick in their gross NPAs, which means somewhere whether it is affordability or retail delinquency, I don't know, but the numbers from a market leader are showing you signs of NPA moving higher. Could that be a challenge for you as well? Because looking at your business, your business setup, your lending rates are actually higher than Bajaj Finance also, or for that matter, banks.
It depends from product to product. Depends on what product we are talking about. 1/3 of my business is gold business. In gold, you really don't get credit issues or credit cost. The bigger challenge that you get is the operating risk, because there could be spurious gold, fraud, so many things which can happen. So that takes care of one element of the business. The second part is the housing business, which again is relatively far more secure. People have always desired to service their housing loan commitments first than anything else. So 2/3 of our business is well covered with these two segments. So therefore, relatively, we believe that we are well placed. We do a very close eye. The more concerning sector relatively would be the microfinance, which is to the lowest strata of the population. That segment is something you need to be very watchful in. We are growing well there, but the key there is asset quality, credit, and we track that even much before the NPA levels. So we track them at 1+. And the 1+ numbers today across our geographies and in areas where we operate is looking fine. And we also make sure that we do healthy and keep increasing our provisions there, so that any stress which comes into the future is well covered. Having said that, we don't really see too much of concerns, anything emanating from any of the products that we are operating today, but we'll always be watchful.
Fair enough. Morning. I wanted to also understand the outlook on, how you're looking at the cost of borrowings, because after rising for the last 3 quarters, the cost of borrowings have come off in Q2. Additionally, your yields have improved. About 17% is what it stands at. Do you think that we should look at this traction continuing when it comes to your spreads and net interest margins?
So on spreads and net interest margin, you will see this trajectory continuing. We have been able to pass on the rate hikes to our customers. And with the expansion geographically we've moved into lesser competitive markets and geographies, which should also help us in passing on the rate hikes in case anything comes in there. So I'm fairly comfortable with our spreads and NIM, and we should be able to maintain that. Cost of borrowing is something which is dependent both internal and external factors. External could be global factors, which depends on how rates will move and going forward. But having said that, we have been very active on the treasury side. We have gone into new geographies and borrowed, like we've gone and borrowed from multilaterals and DFIs as well, which has helped us in getting our cost of borrowing muted and lower. We've also got good amount of refinance from the regulators as well, like NHB and some of other lenders as well, who give you long-term money at fairly competitive pricing. These has helped us in keeping our cost of borrowing moderate. But having said that, if in case there's a need to increase our rates, we'll pass it on to maintain our NIMs and spread.
Enough. And what is the outlook then when it comes to your provisions, because they on a sequential basis as well have increased or risen? Do you see any challenges when it comes to your asset quality, any guidance when it comes to credit costs?
So sequentially they have risen. One is they have risen in absolute number, but the balance sheet has also grown. With the growth in balance sheet, you also need to then provide for the additional book that you acquire and you put on your balance sheet as well. Having said that, we would try to provide more for some of the riskier segments like microfinance and digital finance. But otherwise, our credit cost would be at a range of between 1.5 to 1.75 in the coming fiscal as well.
The outlook on AUM growth as well, because that has come in higher, around 30% in the last 2 quarters. Is it sustainable, and are you going to be revising your guidance?
No, we are not revising our guidance. Our guidance to the market is over the long-term period, we should be able to get to we'll be able to sustain the AUM growth of around 25%. In the last 5 years, if you notice, our AUM, the retail core segments have grown by around 23-24%. A period where we saw COVID, we saw liquidity crisis. we still grew at a good pace. Going forward, the market is looking better. There's enough opportunity for credit growth. We've expanded so much. We added close to one third of our gold branches in the last 2 years, two third of our housing branches in the last 2 years, almost half of our microfinance branches in the last 2 years. With these kind of expansion, we think we are well placed to taper to new opportunities for growth. India is still a credit hungry market, and there's enough opportunity as you go further into the hinterland. So we strongly believe we should be maintained, and we should be able to retain our credit, our growth segments and growth outlook that we are given to the market.
And, you also have got the board that has approved a 3,000 crore rupee fundraise. Largely tell us which are some of the business segments that you think you'll deploy these funds towards?
So today we are growing at a good pace, and when you're growing at a good pace, you would need capital for growth. When you get capital for growth, you're able to then get yourselves more leg space to grow. You're able to then negotiate better with regard to your borrowings as well, because with a healthy capital adequacy and gearing levels, you get those benefits along with growth objectives that you hold. The capital is necessarily for growth, and we have well capitalized our housing business last year. The MFI business would still need some support, and we are looking into how do we support that particular business. Could be through internal fundraise that we do, or could be externally as well. But otherwise, this capital is largely to support the growth for all the retail product segments where we are operating.
Have you on board. Thanks so much for joining in and giving us a sense as to how business is shaping up. That's the view coming in from IIFL Finance.